Thanks for coming here. We're going to talk a little bit about HSAs today and how they can help you out. I just want to describe what an HSA is, how it's beneficial, and then what it'll do to your tax returns if you make these contributions, and then explain kind of some strategies on how best to use them. So what I've put in front of you here is a test tax return. This is not a real person's tax return. I've created an average amount of income for somebody who's just bringing in W-2 income so that you can see the difference between somebody with an HSA and somebody without an HSA and what that does to their total taxes. So an HSA is a pre-tax account that you can use for qualified expenses. Now, the qualified expenses are generally medical expenses and paid out to doctors or whatever it is, and you have to be in a high deductible health plan. So you have to verify that you're actually in a high deductible health plan with your insurance carrier or your employer, just to make sure that you qualify to make these contributions. Some employers do offer these contributions to be made through your W-2, and then you don't even have to worry about writing a check or making transfers into that account. You can just have it withdrawn from your taxes or from your paycheck. Don't even think about it, and it'll reduce your taxable income on your W-2. So, looking at this tax return here, we're just looking at a family. So it's a two-person family with no kids. They made $80,000 as W-2 income. Come down here. There's no deductions, no other income. They are going to pay $5,839 in taxes. Now, this is the number we care about because this is their actual tax number. A lot of people pay attention to this down here, what you owe or what you get back. But for our purposes, we only care about what is the taxes. So $5,839 if you don't make any contributions at all from your W-2. So I'll come over here. Now, this is using 2023 numbers. So the 2023 MATs for a family, this is different for an individual, is $7,750. For 2024, that number will be $8,300 for a family and $4,150 for an individual. So I add that on here, and then let's take a look at what that does to the tax return. So that $5,839 is now $4,909. So what happened was they saved $930 by maxing out that HSA contribution. Now, some people are saying, I can't pay $7,750 or $8,300 or wherever that number is for this year. What some people do is as they get bills in from a doctor or from whatever provider it is that they have to pay, they will then make that contribution to an HSA so that it's coming out pre-tax, even though it's not coming out of your paycheck, and then they'll pay that doctor right away. So really, instead of writing a check from your bank account, you're just writing a check to your HSA and then a check from the HSA to them. That's a great tax efficient way of doing it. If you don't have extra money but you need to pay those bills, do it that way. At least you'll be saving some money. How you calculate what your savings is. So for our test company here, our test people, we look at their income tax rate. Now they're paying at the top rate of 12%. So that means their top bracket is 12%. So any dollars that they put in, they would save 12% of those dollars. For you, you want to look at your marginal tax rate, which means your top, and multiply it by whatever it is the contribution is you're making, and that's how much money you're going to save. So if you're a very high earner, you're going to save a lot more money than a lower earner. These guys are at a lower tax bracket because they're lower income for married filing joint, but they're still able to save that $930. So I hope this helped you out a little bit. If you have any questions, feel free to email me, message me, or go ahead and shoot me a submission through my website, davidroofcpa.com, or you can email me at droof@davidroofcpa.com. Thank you and have a nice day.